Equity Market Update, August 2022. Indian equities surged by approximately 3.5% in August 2022, following a strong rebound of around 9% in the month before. Mid-caps and small caps outperformed large caps during the month. The market movement was impacted by strong FPI buying during the month, easing of US inflation, softening in commodity prices, easing of supply chain, hardening in US yields, hawkish comments by US Fed Governor, hike in policy rates by RBI, etc. Most major sectors, barring IT, delivered positive returns with power, capital goods, oil and gas, banking and metals being the best performing sectors. Most major global equity indices underperformed India and delivered negative returns except Japan and Korea. FIIs were net buyers of Indian equities in August 2022 and bought equity worth 6.4 billion US dollars. On a cumulative basis, FPIs have sold equity aggregating 6.8 billion US dollars in 5M FY23 compared to being net seller of approximately $0.6 billion during the same period last year. DIIs, however, turned net sellers after remaining net buyer for the last 17 months and sold equity worth 0.9 billion US dollars during the month and have cumulatively bought 17 billion US dollars in the first 5 months of FY23. Net inflows to mutual funds in July 2022 stood at approximately INR 17,000 crores and approximately INR 95,000 crores in 4M FY23. In Q1 FY23, results of infrastructure, utilities, banks and NBFC were better than expected, while that of cement, consumer staples, oil and gas and metals were largely in line with expectations. Results of IT, consumer durables, auto, pharma and oil and gas were below expectations. Outlook. As on 31st August 2022, Nifty 50 was trading approximately 19.1x FY24E price to earnings ratio. While the valuation multiples are high compared to its historical average, it should be viewed in context of a resilient economic recovery and steady corporate earnings outlook. The ratio of India's market cap to GDP based on CY23E GDP is relatively high, at around 92%, but within the range of 60 to 100%, in which it has traded over the last decade. Further, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is higher than its long-term average. Moreover, corporate earnings growth is likely to normalize from FY23 onwards. Thus, on an overall basis, market appears somewhat reasonably valued. Moreover, the valuations gap between the current valuation of many sectors have reduced compared to their long-term averages, and for many sectors, valuations remain above its long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. Optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, etc. bode well for the economy and equity markets over the medium to long term. Accelerated monetary tightening, sharp increase in US yields, elevated inflation and commodity prices, slowdown in China, FPI's outflows, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.